All right, welcome back, everyone. And today I'm going to talk about some quick credit game that a lot of people are not going to express to you on how you can actually build your credit while going to college. And by being able to build your credit while going to college, you're going to be able to knock out obtaining an education as well as potentially starting a business or getting investments as well as getting employment and building up yourself all the way around without having to worry about going through some long, drawn out, crazy process. This is actually how I began building my credit accidentally, didn't necessarily know exactly what I was doing, but I was told by someone to do it. So I just went ahead and did it. So, what you're going to do, if you either have a scholarship or if you for whatever reason qualify for Pell Grant, whether it's based off of your family or based off of your own independent income. Remember, just a quick tip: if you live in the state of Florida, if you make more than $15,000 in a year, you can actually claim yourself as independent when you go to college, even if you're under 25, and then you don't need your parents to sign off. So, one thing that I do recommend is for people who are under the age of 21, if you don't qualify for Pell Grant based off of your parents and your parents are not financially sound to assist you, or they choose not to assist you in your educational journey. If you are able to go and get a job, improve yourself as independent, that is a way that you would still be able to qualify for a Pell Grant, and this method will work for you, and you won't be stressing about coming up with money out of your pocket. So basically, what you want to do is you want to go to college and you're going to apply. When you get your Pell Grant, that's going to cover your classes, tuition, and give you a little bit of extra money to cushion your pocket. And then you're going to apply for what is called a subsidized loan. You don't want the unsubsidized, you want the subsidized loan. Granted, you can do this with a unsubsidized loan as well. However, you will be paying interest. The method that I'm going to tell you, you will only be paying the initial loan fee. You will not be paying interest. If you use an unsubsidized loan, you'll be paying both. Granted, it's still not a bad fee to pay, but I just personally don't like to pay interest when I don't have to. So, what is a subsidized loan? A subsidized loan is a student loan that allows you not to pay any interest as long as you are enrolled in school, as well as throughout your deferment process. As long as those loans are deferred, you do not pay interest. So, what you're going to do basically is you're going to look at those loans that are deferred, and you're going to say, okay, these loans are currently my these are my current loans. You're going to take the funds from those loans and you're going to use them either to invest or use them as a safety net. Build up a emergency fund, whatever it is, to have those funds sitting there. And every semester, at the end of the semester, you're going to take what you don't need, pay it down, right? So you're going to pay that loan down, but don't pay it completely off. The next semester, you're going to go and get another subsidized loan and do the same thing. You don't want to pay it 100% off, because if you pay it 100% off, what's actually going to happen is it's going to close the loan out. And so you're only going to get history for as long as the loan is in place. So what you want to do is you want to pay that loan down, pay it down maybe to $100, and let it sit there and let it sit in deferment the whole time you're in school. Then whenever you get out of school, you're going to pay them the remainder of the money. So in this case, because you're using subsidized loans, you're rotating the money. You're either using it to invest or have it as an emergency fund temporarily. You'll be able to actually build an investment portfolio, actually build a safety net, because you're going to be paying into this money. Because like I said, you'll be working, even if you're not working, you'll have this little cushion of money there. And then at the end of your college journey, you will have some money in your pocket. The majority of your student loan debt will not truthfully be debt, it'll be paid off. And then you'll have all of these loans that have showed positive history for the entire time that you're in college, whether that's a year, 2 years, 3 years, 4 years, or longer. So as long as you follow that exact process and you follow it to the T, you'll be able to build your credit in college for essentially free and not have to worry about paying any interest on anything that you have. Plus, you can always take those funds and take them and go to a bank and get a secured card, and open up a secured card with those funds to build up your utilization and your other credit factors. So, with that being said, thank you all for watching. Thank you all for tuning in, and we'll see you guys in the next one.